All right. Good day, everyone. Good to have you here. Welcome to the Tatro Show. Pretty excited about our guest today. Bringing him in all the way in from, I think, his home. I think he's working from home today. I'll bring Martin Roberge in right away. Bienvenue. Welcome, Martin. So welcome to the show, Martin. Pretty excited today. Catching you maybe on holidays? No, you don't take holidays, do you?
No, well, I do, but in August only.
Okay. You are in Montreal, correct?
Well, South Shore. I'm in Candiac, which is about 20 minutes from Montreal.
Okay. For those of you that don't know, I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. I've introduced him, but I'll bring him again more formally. I'd like to introduce right now Martin Roberge. He's Managing Director, North American Portfolio Strategist here at Canaccord Genuity. He's got a CFA. He's been doing this for a while. He's been right on a lot of calls in the past since I've gotten to know Martin. Incredibly smart guy. If you're watching on YouTube, please click the red button to subscribe. Subscribe to our videos, subscribe to our channel. 1 second, folks. Martin, I'm going to bring up your presentation. So this is a document that you prepare, obviously, for your technical analysts and for your institutional clients and for the advisors as well, guys like me, and for my clients and for my viewers. So thank you. I understand you're presenting this tomorrow morning to your institutional call. So thank you for getting us this information, this content ahead of time. I'm going to skip a couple slides here to slide 2. I went one too far, I think. No, this is the one, right?
That's the one I will start with. Okay, today on the show, the case I'm trying to make is to rotate outside U.S. equities, or diversify away from U.S. equities, which have been outperforming global or international equities for about 11 years now. But it seems like we've got the conditions for non-U.S. equities outperformance finally. And one of those conditions is global growth reacceleration. As you know, the economy was hit very hard by COVID-19 recession, and now we're seeing at least the direction of the economy going in the right way. And this chart looks at the momentum, which is the black line of the economy, relative to the lagged impact of oil prices, bond yields, and the U.S. dollar. As you know, bond yields have basically collapsed this year, and oil as well. And we hit almost we turned negative at one point in April, and the U.S. dollar has now started to depreciate. And those are like bottles of oxygen for the economy. So they act with a lag, and this indicator or these variables are represented by the blue dotted line on the chart. And you can see that going into the second half of the year, early next year, the blue line is going to be pulling higher the black line, which is the global economic momentum. So while it's very difficult to have conviction, Rob, on the level of growth, we've got better conviction on the direction of growth, which should be positive until spring next year. And I think we got another chart we can show, like the relationship between the economy and other variables. Yeah, that's the one. So this one is using the balance sheet of various central banks in the first panel. As you know, we've seen an expansion of balance sheets. The Fed, the Bank of Japan, the ECB in Europe have been growing their balance sheets by buying bonds, providing, again, liquidity to financial markets. And you can see the black line, which is, again, a measure of growth momentum globally. And you can see that hockey stick on the right, the balance sheet expansion by various central banks is signaling a strong recovery in the second half of the year. And same conclusion below when you look at the rate cuts that we've seen elsewhere in the world. Global interest rates were around 2-3% earlier this year. Now they're down to 1%. So we inverted the short-term lending rates, and you can see that this line of policy rates around the world, the drop is signaling also a quick recovery in the second half of the year. And I want to repeat, this is the primary condition for non-US equities outperformance, global growth reacceleration. US equities have a low beta. They need lower growth to outperform. They are less cyclical, but international equities are more cyclical. They are a higher beta group of economies, and they need more growth to produce more earnings. So they do well when growth accelerates, and they do poorly when growth decelerates.
So a whole bunch to unpack there. Earlier, you talked about bond yields. Bond yields have been kind of devastatingly low. If you're kind of buying bonds now, you're getting a lot less than you were a year ago or 6 months ago. Has been good for the value of the bonds because of the reverse correlation. You talked here about, about QE and this printing of money, this added liquidity. This has been the theme of my show. It feels like everyone who's come on here in the last month or so. We had Tony Dwyer who came on. We had Javed who came on. I believe we had one other macro guy who came on, and this added liquidity into the markets, this QE, this expansion of balance sheets has been the running theme, and everyone's kind of calling now for a secular kind of bull market, depending on what happens over the summer here. And I'll get to that for you in a bit, Martin. But the balance sheet, the expansion of the balance sheet is kind of the theme of this slide as well.
Yeah, you're right.
Let's take a look here. We've got a couple other slides I want to take you through. I'm going to take you to slide 7, Martin. Or should I stop on this one? No, I should probably go to 7, eh? Yeah, so this is the global growth reacceleration is US dollar bearish. This is the title of this slide. So maybe what's the, first of all, what do we see here? And then what's the big picture?
Okay, yeah, the black line is the US dollar index, okay? It represents about as you know, the euro represents maybe 50% of the basket, but the Japanese yen, Canadian dollar,
Australia
as well. This is a basket of currencies relative to the US dollar. And the blue dotted line is, again, global growth momentum. But again, I inverted the right scale. So when the blue dotted line falls, it means that global growth is improving. And when it goes up, it means that global growth is decelerating. And you can see very well, like I'm not reinventing the wheel here, you can see very well that the two lines are closely correlated, which means that if we are right about global growth momentum reaccelerating and this blue dotted line falling, it will be pulling lower the US dollar line, the black line above, and this is the number 2 condition normally required to get non-US equities going. Again, first condition, global growth acceleration, and secondly, US dollar depreciation. And the depreciation of the US dollar, if you look at historically the ups and downs, the US dollar is a defensive currency. It does well when growth is weak. It does poorly when growth is fast. And as this blue dotted line is showing, we're kind of doing a downshift in this blue dotted line. And as I highlight in the chart, when the line goes down, it means that global growth momentum is improving. So from a directional point of view, again, it seems like we are starting a phase of US dollar depreciation, which was, again, a condition missing over the past couple of years to see non-US growth, non-US equities outperformance. And I think there's another chart highlighting how fragile or how vulnerable is the US dollar going forward when I show relative to the twin deficits in the US. I think it's the following slide, Rob.
Yeah, we'll get to it in a sec. I want to just, we're getting a ton of questions from our viewers and our clients about USD CAD. And, some of the other people on the show have said CAD will have a rough patch, or the CAD, the Canadian dollar, the loonie will have a rough patch here against the US dollar over the next while. And, expect to see depreciation of the Canadian dollar against the US dollar. Now, we're not comparing that here, just to be clear for our viewers. We're comparing a basket of global securities, but it's mostly the euro. mostly the euro and some other, I guess, Middle East and Australian currencies. So does that change your view on the Canadian dollar?
Not at all, Rob. Like if you remember on your show, maybe 2 months ago, we took the view that it was very high likely that the Canadian dollar would experiment a tactical bands as the economy was probably going to stabilize, and also this U.S. dollar weakening. Again, people can look at the Canadian dollar from two angles. One being like the Canadian economy doing well, commodities doing well, hence the Canadian dollar doing well because of its own fundamentals. But you can also take the other side of the trade and say the U.S. dollar is too weak. So when it is weak against a basket of currencies, well, a tide is lifting all boat. It's going to be weak relative to the Canadian dollar as well. So that means that there is upside for the Canadian dollar, but the strength, like marginally, I believe we can go as high as maybe 70, 75, 77 cents, but it will not be because Canadian fundamentals are positive. It's because of U.S. fundamentals that will be going from bad to worse. So when this portion or this side of the trade pushing the Canadian dollar higher, normally the upside is limited. So I would see this rally in the Canadian dollar topping out around 75, 77 cents, and then probably I'm going to turn cautious again. But by the time we get to 70, like again 75, 77, maybe the U.S. dollar will be bottoming as well. So for now, my understanding is that we have yet to see more negative from U.S. dollar fundamentals, which will keep the Canadian dollar afloat. Maybe another 3 to 4 cents from here, but it's probably the maximum we can hope.